what advice would you give it to the entrepreneurs looking to improve their capital raising skills and the due diligence process?
I would today, I'll make this short because we're out of time. If I really want to raise money and increase what I'm doing, then I would step over and say, what does the investor want? And then I would build my model so I'm always delivering what they want, because the investors will rise to the occasion. If you find a really good niche in multifamily or self-storage or whatever you're buying, and you go, this is a great niche, if you structure it fairly and transparently and open, those investors will invest and they'll invite referrals and more people. And what you'll find is a freight train of capital at your door, because what you did is what 99% of most sponsors don't do. They never give the investor what the investor deserves and wants. They only think about themselves. And I see that time and time and time again.
This is the Real Estate Vibe Show, and I'm your host, Vinki Loomba. As a real estate investor and a fund manager, I'm always excited to explore the world of real estate opportunities with you and for you. Today, I have a very special guest, Troy Eckard, with me. Welcome, Troy, to the Real Estate Vibe Show.
Hey, thank you so much for having me on. I really appreciate the opportunity. I'm grateful. Thank you.
I'm so excited that you're here with me today. Troy leverages 4 decades of oil and gas expertise to lead Eckard Enterprises, LLC, securing $850 million in investments since 2019, just like very short term. His company manages over 7,000 wells and has distributed $110 million in free cash flow to investors within the last 4 years, I think, which is really, really amazing. So today, I think we picked a topic on capital raising and due diligence philosophies. We all know capital raising involves securing funds from investors to fuel business growth and also the long-term wealth generation, while due diligence ensures thorough evaluation of financial, legal, and operational aspect. Actually, I'm talking on this topic tomorrow as well, but I want to learn from your experience, Troy, because this is like a really, really interesting topic. So I wanted to ask you this question. What inspired you to pursue a career in capital raising or maybe in the oil and gas investment?
Well, I would say it was a combination of 2 things. One, it was poverty. I was putting myself through college, living in a travel trailer. My parents were broke, so I was paying for everything, had 3 jobs, taking a full college load. And I'd realized that the only way I was going to be successful was I was going to have to do it myself. And so I was motivated to do better in life than my parents had, not because they weren't trying hard. They just didn't have the education or the background. I never did get my college degree, but it gave me a great emphasis to understand what it took to pick out a particular asset. And as good fortune would have it, I had a stepbrother in Dallas that had a small investment firm. And at that time, back in the 80s, of course, oil prices were skyrocketing because of the oil embargo. And he said, hey, look, I've got a job in Dallas. If you want to come work with me, we'll teach you how to be an investment broker. You can finish college up here in Dallas and you can learn how to have a career. And I said, well, I'd like the opportunity. So I started at the very bottom. And within about 6 months, I was his #1 broker. And 2 years later, I had my own investment firm, and 12 years later, my brother came to work for me. He now worked for me. So we switched roles. We switched roles in life, but that's how it turned out. So I've had my own investment company for about 22 years. Now I have Eckard Enterprises, which is a combination of companies, but I literally started at the bottom, and here I am today, 40 years later.
Wow, that's so interesting. So tell me about that short period, the 6 months that you took to get to #1. What did you do? What exactly happened in the 6 months period? That's such a short time period.
Yeah, well, I think that what most people are missing in business, in due diligence, and just generally speaking, is street smarts. They don't have street smarts. And so my approach to capital raising is I always put myself in the position of the investor, always. I say, if I'm the investor, what do I want? What do I expect? What do I need to learn? What do I expect you to tell me? And I want to know in what format. I mean, I want to know all the details of the investor. What I saw the other salesmen, brokers, money raisers, capital raisers doing is they go create a product They figure out what their fees are going to be, and they try to shove it down the throat of the investor. Well, that's like when I was a kid, my mom wanted me to eat beets. I hated beets. I wasn't going to eat. I don't think I've eaten a beet in 40 years. And I thought, you got all these vegetables to choose from. Why do you pick a beet when you know I'm not going to eat it? So that's investments. Sponsors want to do what they think is right because they want fees and commissions and equity. They don't look at what the market is telling them they should be doing. They don't have the versatility. So for me, when I started at 6 months, I would talk to investors and I say, okay, you don't want to do oil and gas. That's fine. What do you do? What do you look for? What kind of investment? What kind of person do you want working for you? What kind of company do you want? What do you expect from making these investments? As I began to understand how the investor saw it, I began to tailor what I was doing to give them or deliver them what they expected. And that's why I quickly went from working for my brother's company. And in 2.5, 3 years later, I own my own investment firm. And then I own my own oil company. And here I am today, 40 years later, because I just said, it's not that hard to figure out. Find assets that work, but present it, provide it, and deliver it in the way the investor wants to see it and what's best for the investor, and you'll win every day.
Great. I love that analogy. So, but I wanted to ask this question. Share with me one example. Since you were in oil and gas, and you're trying to understand the investors, and some investors said, I don't want to invest in oil and gas, but still they're investors, right? As long as they're getting the returns, they really don't care because as long as they're making money, right? So how did you package your deal in a way that sounds interesting to them? They say, okay, let me try this and see if that works, or get me the returns, kind of returns that I'm looking for.
Well, I find the same example in the answer I'm going to give you applies to real estate, whether it's residential, self-storage, multifamily, apartments, whatever. Most people raising money try to sell a deal. What I learned quickly is you don't want to sell a deal. What you want to sell is the asset class. So if I had a particular well we were trying to raise capital for, you described the nuances of the well and such oil companies drilling it and this is the economics of that well. Well, you had to convince that investor to buy into that well. But when you came up with the next well, they would go, well, that well's different than the first well. What's good or bad about this new well compared to what you sell? So you were selling every single day. To me, that was not the approach. The approach is you have all these asset classes. Energy is an asset class. We're the experts at energy. If it has this company's name on it, you have to believe that company is the expert. If they tell you to drill this well in this location, you have to believe and trust that their expertise and opinion is correct, or don't drill any wells. So I don't want to sell you well by well. I want you to tell me that you have an interest in energy. I'm going to deliver 5 or 10, 15 opportunities a year, and I want you to invest in a portfolio, and I want you to create this long strand of investment opportunities in energy. Some are going to do really good, some are going to be mediocre, some are not going to work out that good, but overall, you're going to be successful if you follow our advice. And so it got really easy to raise capital because once I convinced them and showed them the asset class that my company knew what they were doing, I didn't have to explain every project. I'd send them another project, and they would just send money in. I'd send a project, they send money in. And that's how currently Eckard Enterprises has been able to raise $850 million in 4.5 years, is that we sold them on Eckard, we sold them on energy, and they just keep buying. They just constantly. We probably get 40 to 50 new investors a month, call-ins, emails, referrals, just constant coming in.
Interesting. So how did you learn all this in such a short time period? Did you have any mentor?
No, zero. No, I didn't. I'm one of those weird guys. When I was born, my mom said before I could walk, she said I literally was moving 100 miles an hour. I'm an avid reader. I'm super fast at absorbing information. I like to think in an obscure way. So if I'm walking in a grocery store, I'm not really looking at what's on the shelves. I'm more thinking about, well, that's not a good way to lay out the shelves. You shouldn't have the chips next to this. You should have the dips next to the chips. So as I tell my wife, or my wife tells me, she goes, we've been married for 38 years. She goes, you're a strange duck. And I said, why is that? She goes, most people just enjoy dinner. You're looking at the restaurant to figure out why it's being run incorrectly, and why the hostess didn't do her job, and why the kitchen door should swing the other way. So when I analyzed investments, I said, you've got a product. Here's the investor. There is a differential in the way each side views it. If you and I were at a bar and I said, hey, do you see that nice gentleman, that nice looking gentleman over there? You look at the bar and go, I don't even see a guy at the bar. No, the guy at the bar on the left side, you go, I don't see who you're talking about. See, because we're looking at the same thing, but from different perspectives, there's never a connect. And that's why capital raising is so difficult for so many people. They never look at it from the investor's eyes. They try to explain it from their perspective, and it's a language barrier. It's an information barrier. So for me, I was very street smart. I had my first job when I was 10 years old. By the time I was 12 or 13, I had 2 or 3 jobs. I've always had cash in my pocket because my parents were poor. So for me, I always had to be very observant, very street smart, and assess what's around me to understand the rules of the game and how I could win at that game by knowing what was going on. And I just carried that forward into my career.
Wow. So you are seeing more things than the average person. That's a gift, I'm telling you right now, because there's only few people, I think maybe I would say 1% I'll put it, if I have to pick a number, only 1% are on the top who can see things more than the average people. Because when you do that, you're stepping yourself up a little bit, than the other minds around you. So how did you get that mindset? I know you told me a little bit about your childhood, how you came from ground zero and kind of built up and got all the street smartness. But there has to be more than that, getting that mindset, opening yourself up to all the possibilities out there in the world instead of closing down. Because, if sometimes these kind of situations happen, people are just like get into their shell. They're like, okay, I'm not going to do anything, like you said earlier, but
Yeah.
you chose to just burst and just like embrace whatever is coming your way and become who you are today. So share that story with us.
Well, I look back at my back when I was in school, elementary school, primary school, and college. And one of the things I noticed is I was always getting in trouble. I mean, I bet my first grade report card says Troy can't behave in the school, the cafeteria, the hallway, because I always questioned authority. They would say, well, you got to walk in a straight line. I'd go, why? Well, because we want you in line, but why in a straight line? And you got to do this, you got to do that. And so then I would be sent to the office for misbehavior and not talking. But what it really resonated to is when people say, you need to draw inside the lines in a coloring book. And I would go, well, my coloring book doesn't even have lines. Just because some other human being said this is the way you do it doesn't mean that's the right way to do it. Doesn't even mean I should be doing it at all. So when I approach any business, any idea, the first thing I tell my team, we're starting with a blank sheet of paper. Forget the way it's been done. Let's talk about the best way it should be done from what we know today. Mm-hmm. So I'm not looking at what others have already said as the parameters or the boundaries or the rules of the game. I'm saying scratch it off, start with a clean piece of paper, and let's think going forward. Because what it does is every preconceived notion is a constraint. It's a handcuff. It's a block. If you start with zero expectations of what the rules of the game or the lines of the book, that allows your brain to be macro when thinking. You say, so somebody says, I always tell people, they say, you think we can do this and this? And this is my question I ask every time. I say, absent money, what would you do? What do you mean? Let's just say you were a great real estate syndicator and you said, I know how to buy real estate, but I got to raise capital. Forget that. Absent money, what would you buy today? How big would you buy? Where would you buy? Oh, I'd be buying that $400 million building because it's worth $1.5 billion, but I don't think I can raise the money. Again, absent money, what would you do? Because what happens is we have preconceived constraints on what we can do because somebody tells you, you can't raise that kind of money. You can't get financing. You don't know what I can do. So if you approach business and capital raising and relationships with a blank sheet of paper, now it's only limited by your own negative input, by your own constraints. And that's your own evil demons you got to work through. I don't have any.
Wow, I love that. No limitations, It's
None.
like a limitless life. I love how you said people have boundaries because all those are preconceived notions. Those are all the limitations that we create for ourselves. Those are all the barriers in our life. We just feel like we wanted to see how people are going to see us. Most of the people that think about it, how others are thinking about me, that's what I should become. And that's where the limitation part comes. And you're like, I don't care what anybody says. I'm going to set my own boundaries or I'm going to create my own philosophies, I think kudos to you. Pretty awesome. I'm like super happy to hear all that. You're such an amazing person. So let's talk about the due diligence. What are your due diligence philosophies? How did you start seeing the deals? Apparently, it's going to be much different than average people saw. Like you might have heard the example of that elephant, like 5, 6 people looking at the elephant and they were all blind. And they had like different perception of, somebody's touching the trunk or somebody's touching the tail or somebody's touching the leg. So that's what happens in the real world too, right? So let's come back to due diligence, and tell us, how you are doing it from your experience and how you think people should be doing that.
Well, again, the way I look at due diligence is I start with looking at the individual company or individuals that I'm running due diligence on, right? So the first thing you have to assume is you have to assume that there's a lot of bad actors that either they themselves are hiding a lot of things about who they really are, their character, their integrity, or they're incompetent and they're going to try to sell a deal. They really don't know what they're doing. So if you list like the top 10 due diligence questions, they're really worthless questions. Have you ever been sued? Are you under regulatory? Do you have any regulatory issues? What's your track record? The whole market has been a debacle for about 9 years because all these brokers went out of business in 2008. Now they became masterminds and experts and all this nonsense. And so then you start asking, well, what made you an expert? Oh, I just gave myself the name mastermind because all these unsuspecting investors are paying me 20, 30, 100,000 a year to be a member. I'm making 5 or 10 million a year selling fake memberships, right? So my level of due diligence is fine. I say, well, if you're a mastermind and you're the instructor of the class, like in college, well, I need to see your pedigree. Show me your own portfolio. Show me your personal financial statement. Show me what assets you're in. Show me your allocation. Well, I'm not going to tell you my personal business. Well, then why would I take instructions from you? And if you're really bragging how good you are, then demonstrate how good you are in order for you to give me directions. So when I had my own brokerage firm, I'd have people from Wall Street come down and say, hey, we want you to raise money on this real estate or this self-storage or this oil and gas deal, or we have this public fund. And I go, all right, great. Well, here's our financial. I said, no, I don't care about all that. I want to know what's underneath that curtain. So you're going to give me the top 10 answers because you know all the inexperienced capital providers always ask the same dumb 10 questions. And that's what the examiners want to know. Did you ask the 10 normal questions? Well, that's if you're just trying to comply. See, I don't want to comply. I want to win. How am I going to ask the question? I want to know where the crack in the foundation is. So what I will say is, well, you've done projects like this for 4 years. That's great. So let's take a look at the acquisition price in year number one compared to the commodity price compared to the cost of capital at that time. Have you been able to replicate that? No. So year number one, 4 years ago, is a fluke. It was a situational success. You haven't been able to replicate it. What did you learn from that mistake, and what did you do in year two to correct that? Well, year two's down because the market changed. So you didn't learn anything from year one. Year two, your management didn't make an adjustment. Now let's talk about year three. So I would ask the questions of transitional changes and how they change their metrics and what caused those flukes. And they didn't like those questions. Then they would get ticked off or they couldn't answer them. And I'd say, well, being successful is not having a winning year. It's having a winning record. And your record is everything you've done. So I've had bad years. I've had where I've drilled 8 or 10, 15 dry holes. And I'm like, what is going on? And you have to do a lot of self-reflection. So as part of your due diligence, you got to ask the off the beaten path questions. Like, do you have the same senior management team as you did 4 years ago? What do you mean? Well, do you have the same CFO? Well, no, we got rid of that CFO and we have a new one. Well, why? What caused the change? What did the last CFO do wrong that you hired the new CFO? And what does the new CFO bring to the table? Why are you asking that question? You took your main money manager and liquidated that skill set, that intellectual asset, and replaced it. You just replaced your quarterback on your football team. Why? Oh, he wasn't doing things right. We found that his accounting was off. And oh, so you had really bad accounting then, and now you're telling me the new guy's got better accounting. Prove that to me. What have you done since? They don't like those questions, but that is the true heart of a due diligence is you're asking the off the beaten path questions, and those questions are tied to other relatable questions that nobody wants to ask. That's how you find out if it's really a good management team and if it's a good asset. You ask the questions that other people don't want to answer, and you make them answer it.
So let me ask you this question. How do capital raising and due diligence philosophies work together?
So two things. I only offer investments in assets that Eckard owns and that we manage. So I don't do outside capital raising. I don't have an investment firm anymore. So any due diligence is done on my own product. But what I do is I assume that I'm going to have a SEC examiner come in or a FINRA examiner or a state regulator come in. So I still run my firm as if it is an investment firm, but I don't have an investment firm. And the reason I do that, it's the highest criteria of due diligence, right? Mm-hmm. So in order for me to be successful at capital raise, I have really 3 things I have to think about. A, I got to think about the investor first. What is the product? What are the results? What are the traps that may make that investment derail or fail or succeed or stuff, right? Then I go back to the due diligence and saying, how do I run the traps on the due diligence to find that asset? My saying has been for 40 years, it's super easy to raise money. It's really hard to find a good deal. Raising money is easy, easy, easy. Finding a good deal is damn near impossible. So the middle part of that ground is, and this is important, if I find a good group of investors that want a particular investment, so I got a willing participating capital provider, right, investors, and I've run due diligence and I find it's really good, and there's no arbitrage, there's no way for me to make a living, it's useless. Why? Well, that's like a really good shoemaker makes a great shoe, but everybody's at the beach and they're barefoot and there's no supply because there's no leather to make the shoes. I don't have a job. So somewhere in that triple relationship, I got to have clean due diligence and transparency. I got to have a way to make a living, and I got to deliver that product with me making a living in a way that makes sure the clients get what they want. That is the hard part. Usually people forget one of the three. They make money for themselves and the investors lose because they didn't do their due diligence. One of the three is a mess, right? So I think that part of that synergy is you got to have a business plan, and the business plan has to be macro. When I started in 2018 on the current business plan, I sat down with a piece of paper and I said, all right, where do I think this idea is going to end up in 5 years? And how do I build it based on capital, due diligence, back office support, adding personnel and growth? And I wrote it out. And when I wrote it out, I had it based on capital, assets acquired, number of investors, et cetera. And I wrote it out. I can look back now over 5 years, and it was almost exactly spot on with timing and number of clients and capital raised and assets bought, but I actually tripled it. I did 3 times more than I thought I was going to do because the model works so well. So in order for you to have good synergy between your due diligence and your investors and your own effort to have some kind of motivation to do it, you've got to kind of have them all laid out at the same time. And you got to start with one brick in your foundation at a time and grow slowly. Most people are not patient. Most people don't want to develop a plan. They want to go, this looks like a great idea. Let me go sell it. And they might get lucky on 1 or 2 or 3, and then 4 and 5 fall apart and they fail. And then their model falls apart after 3 or 4 years because they never had any architectural plans to build a fortress for their investors. They simply had an idea to put a wall up, and the wall fell down after 2 or 3 years. That's what we're seeing now. We're seeing all these sponsors failing, all these Ponzi schemes, all these failed ventures because they were led by people who had an idea. They were frauds, they were fakes, they were incompetent. And then you and I are looking at it going like, well, who would have put money in that thing? The most basic due diligence was not done, and one of those 3 components did not exist.
You know what? This is so funny the way you laid. But there's only 2 kind of people in this world. One is leaders, one are followers. So we see more followers in every industry than the leaders, And then the followers, they think they are leaders, but somewhat they are following others and they're trying to do what others are doing versus creating their or pave their own path, where they wanted to walk. And that's where I think that disconnect is big one, whatever you're talking earlier. I wanted to understand from you, I'm not sure how much you can share. If you can share your model with us a little bit, how did you create that model? And that's working for you over the years. And then you're polishing it, I'm pretty sure, every time when you go through that. When you started maybe very small and now it's so big. So that's how it happens with everybody, because everybody wants to make money day one. They just want to jump that wall and they say, okay, bam, I'm going to land on $10 million, $100 million day one, but that does not happen. You have to take the baby steps to get there. And then you have to refine your model. And that's the reason I wanted to bring in the followers and the leadership,
Yeah. So the way I started back in 1985, when I was a young broker, I didn't know a thing about oil and gas. So there wasn't any books, there was no internet. So here I am talking to investors about investing in oil and gas. They're asking really fundamental questions. And I'm like, I'm just repeating like a parrot what I hear from other people, but I really didn't know. So I looked at my manager and I said 2 things to him that was really profound in changing my success in my career. One is that, is there anything that prohibits me from driving down and going sitting on that well site for 2 days and just watching what they do and asking questions? No, but don't do it on Monday through Friday because you got a job, but I don't care what you do on the weekend. I said, okay. So I'd go down and sit down and I'd talk to the guys physically drilling the well and doing what they're doing. And I'd say, I'm a kid. I don't know diddly squat. Teach me anything. I'm the dumbest guy out here. Teach me whatever you know. And I learned it. And I learned how it worked. And I learned the intricacies of that, right? Not because I'm mechanical, but I just want to know what I was selling. The second thing I told my boss is I said, I wouldn't give you $25 if I didn't know who you were. I don't trust anybody because $25 is a lot of money to a young kid. So I don't trust people. How's that guy in California going to invest $500,000, $100,000 in a drilling deal? He don't even know who I am. He goes, well, they do it all the time. I go, but wouldn't they do it a lot more if I got on a plane, if I flew out there, took them to lunch, they got to see my face, know who I was, know my sincerity, and then all of a sudden they're investing in what they want to invest in, but now they can put a face and a personality and a level of trust on a connectivity. He goes, you want to do that? That's on you. You pay for your own airfare. You do it on your own time. So I started off at 21 years old using pay phones and no cell phone and paper maps, going out all over the country, going to see clients. And it was profound difference, because what I said is, what would I want? Well, I want to know that you know what the heck you're selling. Tell me what's going on in the rig. I want to know you spend time in looking at my assets, because that means I trust that you're watching my money. And then the fact you come and see me tells me I'm not just a name and a number. I'm truly somebody you trust. So if I'm in real estate, let's say I'm doing multifamily, I'm going to go spend 3 days and sit on my multifamily. I'm going to watch my manager, and I'm going to find out about my tenants, and I'm going to sit in the parking lot, and I'm going to talk to the landscape guy, and I'm going to run around and do that. I don't do it on every one, but when I started out, I did. And they were like, "Who are you?" "Oh, I'm the owner." "You're here watching the guy mow the grass?" "Oh, absolutely." "Why?" "I want to know what goes on in my asset." And I carry that over to everything that I do. So I've got 130 employees right now, right? And I know almost every one of them by name. And I go to every field, go to field trips. I do it. Why? It's not because I'm some kind of hero. It allows me to see the true underbelly of what's taking place. So that way, when something is changing, I can feel that ripple changing long before it gets here. And I think that's what really makes the difference in being successful is you can pretend like you know what you're doing sitting in the Eiffel Tower in the corporate office way back here. Or what you can do is say, "Oh, you're going to the field tomorrow to see a rig? I'll go with you." "Really?" "Oh, I'll be there. Don't worry about it." Why? Well, one, I enjoy what I'm doing. Number two, I'm going to guide this vessel better as the captain of the ship. If I've been through that strait 100 times, if I've seen how they load the ship, if I see how the navigational system works, then I speak from confidence and experience, and I'm not just going, yeah, because what you said is absolutely correct. All the investors, they don't want us to make any money as sponsors. They want to whittle us down so we work for free. They want the very best of the best. They want us to tell them which asset's the winner and which one's the loser, so I can get only the winners. And then I'm currently suing 11 of my clients right now that stole my data, stole my proprietary, came to my conference, and they're out competing and badmouth me, and I'm suing them for about $100 million. Why? Because you can't steal my work and my 40 years experience because you want to be me. If you want to be me, go spend 40 years putting in 100 hours a week, then you can be me without stealing my data. So we have a tough tightrope to walk. Now, I will tell you, I don't apologize for my fees, and I don't apologize for who I am. They say, "Well, you're making a 30% gross margin. I should be making 60%. When I divide the number of hours I put in, I'm making $8 an hour. So guess what? You want to pay me 29%? Then I won't take your call for a year. How does that sound? You want to buy junk? Then you go talk to the guy that's going to charge you twice the price and talk to you anytime you want to. You want to make money? Then pay the expertise. If I'm going to have brain surgery, I want the best neurosurgeon. I don't ask about his price. That's how I run my business."
Wow, I love that. Gosh, we are out of time. I wanted to ask you many more questions, but last question I want to ask you, what advice would you give it to the entrepreneurs looking to improve their capital raising skills and the due diligence process?
I would today, I'll make this short because we're out of time. If I really want to raise money and increase what I'm doing, then I would step over and say, what does the investor want? And then I would build my model so I'm always delivering what they want, because the investors will rise to the occasion. If you find a really good niche in multifamily or self-storage or whatever you're buying, and you go, "This is a great niche," if you structure it fairly and transparently and open, those investors will invest, and they'll invite referrals and more people. And what you'll find is a freight train of capital at your door, because what you did is what 99% of most sponsors don't do. They never give the investor what the investor deserves and wants. They only think about themselves. And I see that time and time and time again. So if I'm an entrepreneur raising capital, there's plenty of money out there, by the way. I hear people can't even raise 4 or 5 million right now. We're about to cross $100 million in capital raise already this month, and we'll probably clear 300 million this year in capital. Everybody else can't raise $5 million because we're delivering what the client wants. That's what I would tell your entrepreneurs. Stop thinking about you, think about the investor, and work really hard to find the right deal. You'll raise all the money you want to raise.
I like that. Share one more golden nugget with my audience. Could be mindset, could be anything, whatever you like to share.
All right, this goes to entrepreneurs raising capital. You ready? If you have 2 dogs on your back porch when you wake up tomorrow morning, one's fat and one's skinny, which one are you going to feed, Vinki? Which one would you feed, the fat dog or the skinny dog?
I think the obvious answer is skinny, but I will go with fat.
Yeah, your answer is right. Why? When you walk on the back porch, you see the skinny dog, you think he's got mange, you think he's rabid, you think he's somebody else didn't like him. You walk out and you go, get off my porch, get out of here, you scroungy dog. And the fat dog, you're going to feed and you're going to pet. The lazy sponsors, the overcharging sponsors, the crooks, the Ponzi schemes, they're the fat dog. Why? Because they're not doing a damn thing but taking your money and living on your back porch. The skinny dog is not fed because he's looking for the right meal. And the truth is, human nature is we always want to go to the fat dog, the mastermind, the so-called expert that looks right. I'm a doctor, I'm retired, but now I'm a financial expert. It's all a bunch of BS, right? The skinny dog is the one that really needs to be fed because the skinny dog is probably the one that's hustling, doing his job, but we don't give him time. So my nugget for you is as follows. Don't fall for the fluff. Don't fall for the great website. Don't fall for the nonsense. Don't fall for the I'm the mastermind. Talk to somebody like yourself. Talk to somebody like your organization. Say, just tell me how you do your business. Show me that you are a really incredibly hands-on sponsor because that's who I want managing my money. But when you start asking those questions, you're going to throw about 98 sponsors' names in the trash because they don't exist. It's very rare to find good sponsors that tell the truth, that are competent. Very rare.
Thank you so much. I love that golden nugget. That was really nice. And then I have a rapid fire round now. I'm going to ask you 5 questions. You're going to answer it in 1 word or 1 sentence only. Are you ready?
I'm always ready.
All right. I like that answer. What is one of the most important things that you have learned in your life, and how did your life change after learning it?
Stop hating myself because it's a negative way that acts like poison in your system. Don't judge yourself. Just be the best you can be and know that is the best you could have delivered. Don't hate yourself.
I like that actually. So let's take a minute and talk about that a little, because a lot of people, they have so much self-criticism, or they're their own critics. And that's the biggest limitation for everybody, because we are beating ourselves up without any reason. So I would like to hear your experience a little bit. I know we are in the rapid fire, but since you mentioned that, would love to hear that.
Well, I'll make it very simple. I grew up, I was adopted. My biological father deserted my mother and 4 kids. I was adopted by a great guy. And what I learned over life is you start second guessing who you are. Are you worthy? Did you meet your goals? I didn't graduate college. My friends have done better. And so you spend all your time kicking your own rear. And I just turned 60 years old about a week and a half ago. And when I finally figured out, and I just did my own podcast on this on my own show, and I said, it's IDGAS. And everybody goes, what's that? I says, I just don't give a shit. And they go, what do you mean? It's not being arrogant. It's saying, I'm happy who I am. And I'm being generous. I'm being faithful to my religion. I'm being faithful to my family. I'm working hard. I'm giving you everything I've got. And I don't care whether you like it or not. And I don't care whether it make you happy or not. But I'm doing everything I need to do to be a good human being, a good father, grandfather. So IDGAS is my answer. So that helps you stop hating yourself, because what you finally say is, I don't have anybody to prove myself to, including investors. If you don't like it, go invest somewhere else. And if you do like it, then be a positive influence as one of my investors and partners. Because if you're going to be negative and crying all the time, cry babies to the right, and I don't go over there. Go cry over there. So not hating yourself is probably the most important thing. Letting yourself look yourself in the mirror and say, I am very much a good person, great person, successful person, and I'm giving everybody as much as I've got, and that's all I'm going to give, period.
I like that, because the more you appreciate yourself and accept yourself, that's how you're going to project to the outer world. Because
Correct.
if you criticize yourself, others going to look at you that way too, because you're emitting that energy. So share one good book that you like to recommend to my audience.
I've always liked Good to Great. It's an old book, been around a long time, but I tell you, I read it often. I read it multiple times for the simplicity of it. Every day with the 130 employees I have, I'm constantly telling my senior management and my department managers, we're not looking for silver medalists. We're looking for gold medalists. Some are gold medalists, but right now they're immature, inexperienced. They haven't been trained. Sometimes you have somebody who's mature and older who thinks they're a gold medalist, but they've already decided they've given up on their career and they're actually going backwards. They're sitting around just being on the bench. Every day we must think about going good to great. Who's on the bus? We should take off the bus or reassign them, because that bus, the more people you add, the more weight it is, the more slow it gets, the more lethargic it gets. But if you're constantly staying focused, my mantra with my wife and I is work like you're broke. We got that after the 2008 crash. She's like, you need to work like you're broke. I said, I am working like I'm broke because 08 almost wiped me out. She goes, but what I want you to think about is, don't let your guard down. As soon as you think the economy's figured out, the government's figured out, taxes are figured out, the different asset classes are figured out, something catastrophic happens, and also your rules upset. So work today like you're broke. Don't be lethargic. So that's what I do every morning. I'm up at 5 o'clock. I'm at work and I work like I'm broke. And she's like, when are you gonna stop working? I said, you told me to work like I was broke. I said, so I am. So it's the intensity I would recommend. Be intense always.
So in one word, what does life mean to you?
Freedom.
What is your biggest passion?
My family.
I love that. If you could turn back in time and talk to your younger self, what would you tell yourself and why?
I would have told myself to go about half the speed and to allow yourself to think through a process before you took action. When you're type A like me, you're constantly on the go. Well, a lot of times you waste a lot of energy. I would have stopped drinking alcohol. I would have never drank alcohol. I quit 7 years ago, cold turkey, because I've been drinking since I was 10. The hours wasted, the lifestyle is not good. And if I had anything to tell myself, it would have been go half speed. As you turn 60, gosh, I would have had 20% of what I know today when I was 20. The tens of millions of dollars I would have saved for myself and my clients would be off the chart. So if I'd gone slower, maybe I wouldn't be as successful as I am today, but I also probably would have had the opportunity to miss a lot of bad ventures, a lot of bad people, a lot of bad deals, because I'd have taken my time to maybe be a little bit slower. That's why one client told me a long time ago, Vinki, and I think it's the smartest guy I've talked to. He said, look, Troy, you're a young man. You're in your 20s. I'm 60. Everybody makes all their income from 20 to 50. They spend it on cars, planes, trains, girls, whiskey, booze. They waste it. Your true wealth is built in your 50s and 60s. You just got to get there. And that is the truth. My entire majority of my net worth has been built in the last 10 years. And as a result of having 35 years of experiences, good and bad, I stopped chasing deals and I focused on a plan and I focused on a direction and a strategy, and I methodically put it together, and it's exploded my opportunity for my clients, my investors, and for my company. But you don't know that when you're 25 or 35 or 40. You go, that 40-year-old guy, he's an old fart. What does he know? That 70-year-old, we don't do things like that anymore. Let me tell you something. Doesn't matter if you have an iPhone, doesn't matter if you have the internet or you didn't have the internet or pay phones. The person who's been through that experience is worth their weight in gold because it keeps you out of the bushes. It keeps you out of the ditch. And I didn't do that. I should have listened more and more carefully, but you have to slow down to do that. Today, you and I should have 20-year-olds buying us lunch and coffee saying, I just want to spend 30 minutes. Tell me everything you know about what happened to you, good and bad. Because that is a PhD lesson in business entrepreneurship. And that's what I've got. I've had probably 4,000 multimillionaires as clients in my career. That is a PhD better than Harvard or any Ivy League school on how to run a business and character and integrity. So for me, that's what it is.
Wow, I love that. So it's like slow down to speed up. That's my mantra too. So how can people reach out to you, Troy?
You can always call my office, 800-527-8895. You can call me or text me on my cell phone, 469-422-1781. I take calls up to midnight, and I'm not scared to talk to any of you. Or you can just email me at teckard@eckardenterprises.com, and I'll be glad to answer questions or direct you to anybody in my company. See, I want to be the most transparent founder and chairman of the board of any private alternative asset class, because the reality is I see my clients as investing partners, not as investors. You're my partner. When you invest, I'm helping you on other deals that have gone bad. I'm helping direct them to great people like yourself. I don't do real estate, so go see Vinki. All right. I don't do XYZ, so go see this CPA. It is collaboration and strategy. This is what was going on 30 years ago. 30 years ago, investors talked and collaborated and shared. Now everybody has rear entry garages. They don't talk to their neighbor. There's no front porches. We don't talk to each other. We're all being sucker punched because we become isolationist, and that needs to change. We need to collaborate. And that collaboration is a tight circle that keeps all the scumbags and crooks and incompetents out, and only a solid core group of professionals like you and I working on behalf of wealthy investors, period.
Yeah, I love that. I'm a biggest proponent of collaboration too, because that's what the rule of the game of life.
Yes.
Because we are here in this life to connect with others and help each other grow. So when you find the like-minded, when you're collaborating, you scale much faster than going alone. I really love talking to you, Troy, today. You got a great mindset. Love this episode. Maybe I wanted to have you back again. But
Sure.
thank you today. I appreciate you being here.
No problem. Thank you so much for having me. I appreciate it.